Hello and welcome to the Property Trio, the podcast for the sophisticated property buyer. Today we've got market update, the month that was May. Of course, May was a very big month for the federal budget. We're not likely to see that in any of the data today, except sentiment, but we'll keep our powder dry for that one. I'm joined today by only one of the musketeers, to borrow your expression. Cate Bakos, good morning.
Good to see you. We get to do market update together.
Yes, Dave is out for this particular one, and we look forward to having him back next week. Let's get right into it, Kate. Let's look at the headline numbers. National prices went nowhere, 0.0%. So it's going to be a boring show, or is there anything else to talk about?
Yeah, not a boring show at all. Really interesting outline of performance across the capital cities and the combined caps and regions this time round. The ones that led the price falls were Sydney and Melbourne at 0.9 and 0.8 respectively for the month, which is a big fall. And I hate to say this because we were just showing signs of warming up in Melbourne. You can feel it. You can definitely feel that the market experienced a shock. And I think it's fair to say that the biggest shock was the announcement, the budget announcement, which is still not legislated, but of course, it has a very instant effect when significant legislative changes are likely. And I was just chatting with you off air about all of this. A lot of journos have asked me, well, where are the falls? Are they, an investment type stock? And not at all. It's sort of everything except renovated family homes. They've always been highly prized and really competitive and few on the ground, and nothing's really changed. Your higher end stuff has definitely come off, but across the board we've felt it, and it's because everyone has stood back. And let's talk about what the intended suggestions or the intended announcements on budget night are all about. It's about giving first home buyers an opportunity. It's about giving renters an opportunity to get into the market and be first home buyers. So it's all about first home buyers, but the thing that first home buyers do is they react the hardest to a shock. They react the hardest to a market that's showing downturn, and they get really nervous. And when people get nervous, particularly firsties, they sit on their hands and do nothing. So that's what I'm seeing. I've had auction activity where, some of them have performed, they've put their hands up, but not in any kind of committed sense. They've not reached reserve in almost all cases. We've had a lot of pass-ins and we've had, easy negotiations. The vendors that are selling right now seem to be the ones that have to sell, so they are meeting the market, and hence that's why we've seen price falls. And I think, like a lot of other shocks that we've had, this too shall pass. I say that to everyone once we get our heads around it. And I think once we've got clarity on what will be legislated, I think that's when we'll start to see a bit of normal owner-occupier behaviour. But it's the investors that are doing different things. So let's talk about the capital cities that have been flying for a long, long time. The two biggest performers for this month were Perth and Darwin, and they both exhibited 1.5% growth in 1 month, which is still really strong. And I look at that with a degree of scepticism because budget night was March the 12th, and I find it hard to believe that 2/3 of the month would have been in shock with investors not participating, yet we've got these two capitals recording that kind of performance. The others, I wouldn't call them lackluster, aside from Canberra at -0.2. We've got Hobart at 0.9, which is strong, Adelaide at 0.5, and Brisbane at 0.9. So really, it's the two biggest cities that have pulled down that weighted average. Now, when we have a look at combined capitals, -0.1, and combined regionals, 0.6, I predict that June's going to look different. I think that the regions will pull back a little bit because we've seen a lot of investor activity in the regions. But what do you make of it, Mike?
That's a good point, especially the Victorian regions, I think will maybe be a little bit more exposed to the potential falls. You think about places like Ballarat, and you'll know better than I, but hell of a lot of buyers agents that aren't locals were active in that particular market. And hearing from buyers agents in the last little while, the inquiry tap for investment specialist buyers agents has been turned off to some degree, depending on who you speak to and how honest they want to be. We're talking, somewhere around 60 to 80% drops in inquiry since the budget. So that's very, very meaningful. I think WA region is leading the charge for growth at around about 22% last time I looked at it, 23%. That's an interesting case study as well, because WA is not cheap anymore, right? Like when we talk about the beginning of the cycle around 2022, it was one of the cheapest capital cities that you could get. Obviously, got a great economy, great lifestyle factors, but I wonder if there will be some pullbacks in some of those regions that are not necessarily supported by great fundamentals. There's just been a little bit of an investor gold rush.
Yeah, I wonder, because I had a good look at, the markets that I'm close to, namely, or the regional markets that I'm close to. And I know I'm sounding very Victorian-centric, but I'm just using them as an example. Both Ballarat and Geelong have enormous growth in their housing estates. So the buyers agents aren't leaving those cities alone. They're just opting for buying new. And the house and land package in one of those locations is far cheaper than in the capital cities. So I'm not feeling entirely nervous about the performance of those markets, or a downturn in population growth or anything like that. I just think that we'll see a very defined shift of investor activity, which it pains me for other reasons, only because I've never really subscribed to brand new as an investment because of the land to asset ratio, but I digress.
We were chatting off air about our data, where we were looking at the percentage of property investors that come through our business for tax depreciation schedules. Obviously, it's skewed a little bit towards new property because the benefits are there, or at least, people are more aware that new property has better deductions. But we saw around 30% of investors buying new in the lead up to the 9th of May 2017 change, which made depreciation more attractive for new property, i.e. you could claim the plant and equipment items only on new things rather than established things. So to me, that is kind of like a baby version of what we're seeing right now. New property was incentivised on the 9th of May 2017, and on the 12th of May 2026, that incentive actually went a next step. So plant and equipment deductions, that's meaningful, but negative gearing compared to depreciation deductions, that's a way bigger incentive to go new. So I am expecting the percentage of investors that we see buying new, which is really hovering around about 20-25% at the moment. I expect a marked increase. Is for a good reason. Are they quality properties? That's a different story. This is more about a market reaction.
I can't wait to see the impact of this legislation when we have interest rates dropping, if and when. But there's constant movement there. If we had this legislative change back in 2021 or 2022, I don't think it would have spooked so many people when they actually ran the numbers, because we've talked about this on the show before. We've assessed the deductions that people got via negative gearing during that time, and we saw a lot of cash flow positive outcomes for a lot of investors. And you've got the ATO data. Let's just touch on that for a moment and step down memory lane.
Yeah, well, I mean, the latest ATO data hasn't been released that long ago, and I was thinking about doing a whole episode on that. So we had the 21-22 data, we've just got the 22-23. Believe it or not, that is the most recent data we have, because there's quite a lag with that. We actually saw a little bit less property investors than a year ago. But what was interesting for me was to look at the investors that own one property all the way down to 6 or more. The less properties you own, the more likely you are to be negatively geared. It moves from about 50% of first 50% of investors that own one property are claiming negative gearing deductions, and it drops to about 40 for 6 or more, which is still a bit higher than what I thought it would be. But what that sort of says to me is that it would have made more sense to cap negative gearing to 1 or 2 properties than get rid of it, because the people that are benefiting it the most are not the multi-portfolio investors. They're the people that have one property, right?
Yeah.
And so
It's the
that
start of your
rent vesting,
journey.
yeah, and the rent vesting pathway has kind of been shut by this policy. So I know One Nation have said that they recommend capping it to 2 rather than abolishing it entirely, and they're against the CGT stuff. So that is something that I'm sure that the Labor government were looking into, but yeah, it's a bit of a missed opportunity, I think, to help young people, because that was the idea, right?
Yes, that's right. That was absolutely the idea. Well, we've digressed completely and gone straight back into politics, and you can blame me, sorry.
That's all right.
The median values, I was fascinated with this, not in a great way either. It's one of those horrible fascinations. Melbourne's median dwelling value, and we've got to remember our blend of apartments to units to houses is quite different to places like Hobart, but we are the 3rd lowest nationally now at $812,621. Hard to believe. I'm looking at Sydney at almost 1.3, Perth at $1,050,000, Adelaide at 951. Like, who would have thought? But I'm looking at Melbourne versus Hobart. Hobart's not very far behind us. There's literally 60 grand in it, which is a big surprise. I've never ever seen that parity.
It's insane, isn't it? And you think about the long term sort of, like, if we averaged it all out, you've got Sydney number 1. Of course, there's periods in the past where Perth overtook it, and there's some weird lumps and bumps along the way. But it's normally Sydney, Canberra, Melbourne, right? Like I wouldn't normally talk about Canberra, but yeah, like for the last sort of 10 years, that's roughly been the order. But it's a snow globe that's been shaken up, and it begs the question: like, is Perth property worth more than Melbourne property, or that close to it? I'm interested in your thoughts, because we have an industry buddy who was very anti-Melbourne, and when you were seeing fever pitched activity in Melbourne, we were only really seeing, like, point whatever of a % of growth. Now you're actually saying it's actually quite depressed. So if when it feels hot, it wasn't really doing anything in the totality data, when it feels cool, like, could we actually see a couple of percentage point drops in the next quarter? That would be interesting to observe.
Yeah, I think we could. And, just to clarify where it was hot, because segmentation is so important when you're talking about this kind of stuff. I was seeing really heated performance in the lower and middle quartiles, but certainly not the top end stuff. And we've had, a lot of apartments on stream, so they've really languished over the last 15 years. But I'm a buyer's agent as well, and you'd like to think that I'm selecting property that is popular because it's not compromised and more people are bidding on the quality assets. All that aside, the investment locations that have really been humming, they were so hot and so difficult to get into. Some of them I was concerned about bubble territory, and I steered clear of them. So yeah, Melbourne hasn't told us a consistent story at all.
Let's shift gear and talk about rents. Now, rents, I think, is going to be a really evolving story, because we've got the Treasury modelling of $2 a week increase. We've got the grandfathered negative gearing, which they're hoping will stop people from selling the property. If you're buying now, you can negatively gear until 1 July 2027. But I can't see any way to there being less investor participation, especially when you're thinking, if you're buying anything around the country, it's going to be in a negative cash flow position, and that's not going to be immediately deductible after 1 July 2027. And I think most people aren't trying to buy an investment property for 6 or 12 months. It's more of a long-term view. So where are we at with rents at the moment, and what do you think is likely to have happen? Is the government going to get that soft landing where it's like rents don't go up because less rental pool or there's less people in the rental pool because they've bought a first home?
Well, our rents are telling a slightly different story for houses versus units. Units are a lot more patchy and scratchy on this chart. Houses, they're all trending up. Now, what is really interesting is aside from Hobart, the strength of rental growth is consistent in terms of the league ladder. So Darwin is showing the strongest growth across houses and units. Hobart is showing the strongest growth, the second strongest growth for houses. It's showing the fourth strongest growth for units. But if we back out that, it's then Perth, Brisbane, Sydney, Melbourne, Adelaide, and then Canberra. Now, the only one that's within our target inflation band is units in Canberra. Everything else is well above it. So our lowest the lowest above the target inflation band, which is 2 to 3%, is Canberra houses at 3.9, all the way up to Darwin houses at 10.5. That all sounds pretty awful if you're a renter. Now, my concern about houses is a significant one. If we see older Australian investors or, mature investors or investors who are at the end of their acquisition journey and they're looking at putting their assets into their superannuation or buying shares or whatever, because, once you get to retirement age, you're not leveraging anymore and you've got to ask yourself, are you better off being in property or are you better off being in shares? And there's CGT to deal with, but if you're staring that down and you're sick of maintenance costs and you're sick of property managers and having to upgrade your properties and all of the things that go with property investment, and you're no longer getting the benefit of leveraging, you probably say to yourself, well, let's sell one or some or all and do something else. Now, my concern is that a lot of those investors who are at the end of their investment journey and looking to do this kind of stuff usually have houses in the inner and middle ring because they've been holding them for a long, long time. And they're staring at a CGT bill that could be really frightening. So they'll be asking themselves, well, I've got 50% guaranteed between a sale that's between now and the 1st of July next year. Let's just sell now. Now, if we do see a disproportionate number of investors in that area, in that segment of the market with houses selling, we're going to lose those houses in the rental pool because they won't be sold to investors because they're established properties. They'll go to homeowners, they'll go to upgraders, all of that's great, but it will displace tenants who have been in those locations for a long time and needing a family home. Their only option for a family home will be to move much further out or to readjust how they live and target units and apartments. That's my prediction. So I think we're going to see housing rents skyrocket. I think units are a different story and we've got different weightings of units in different cities. So I don't believe that we'll see the same performance for units in terms of rental growth that we will for houses, but it's a big concern.
Here's something I thought might be interesting to you as I was looking at this data yesterday in preparation for a presentation I did last night. You mentioned that in terms of rental growth, say for units, Canberra is absolutely at the bottom. Darwin is at the top. When we look at the annual housing targets versus completions, I'm talking about the 1.2 million homes over 5 years, and we compare it state by state. The ACT is doing the best. It's only 7% behind its target, whereas you compare that to NT, it's about 81% behind. And in second place after the ACT is Tasmania at 53% behind. It's interesting to observe that the states that are doing better with construction are seeing lesser rents, and the states that are lagging behind are leading the price growth tables. Any surprises there?
Oh, what do you put it down to?
Well, I think especially places like the ACT, it is fairly good at bringing units to market, right? And it's been building a lot better than any other state, right? I was speaking to Marty, my business partner, the other day. He went to Canberra for a bit of a housing accord meeting, and he sort of said these targets aren't achievable. The problem will be local councils. And there was a minister there that said, well, there is no local council in the ACT and it'll go across my desk, so I'll make sure that it happens. And Marty was thinking it would be interesting to see like the data, like was that guy sort of talking out his hat, or is there a degree of friction with local councils that is holding the supply back? And I think that data says there's something in it. ACT is doing a lot better than everywhere else. If you go the next one after that, it's Victoria. They're only 10% behind their shortfall, and WA 16% behind the shortfall. But an interesting trend that we've sort of identified and we've talked about a lot is that when we see a market get sort of flooded with investors, or there's a lot of investor activity like Darwin, we kind of expect, okay, well, the rental pool expands, then rents would shrink. But we're actually seeing Darwin houses and units the top of the table in terms of rental growth. And what I suppose we've posited... Sorry, go on.
I've got a couple of theories on that. We've chatted about it before. One is with new investors, you get a chance to set a market rent.
Yes.
And I know, being a long-term investor, it's easy to let them slide. You have a really good tenant, or your eye's not on the prize, or your property managers drop the ball, or they're wanting to keep everyone happy. And property managers can talk you down on rent very easy. As soon as you switch a property manager, you're all surprised because there's another $50 a week there. I'm not saying this to sound like a landlord that's greedy. My point is that a new landlord or a new investment property will reset the rent usually at the right level, and from there it can start to cascade down over time. And the other one, which seems obvious to me, is in these locations you're dealing with FIFO workers to construct all this stuff, and they have to live somewhere.
Yes, yeah. It's interesting to see Darwin doing so well. Obviously, that market's been going crazy. Hobart has come off the bottom pretty hard. We're 0.9% growth for the month of May. It's in second place for houses. Then we've got Perth and Brisbane in third and fourth place for houses, and second and third for units. These are markets that have been hammering along. So it's really interesting to see that the capital growth and the rental growth are actually kind of running in tandem there.
Yeah, absolutely.
All right. Well, let's move on to the next one.
Gross rental yields.
Yeah. When it comes to gross rental yields, I mean, rents have been doing really well, but as I mentioned, in concert with capital growth. So yields aren't looking that good at the moment. Most sort of cities are in the threes. What's your observation, and what do you expect to change if we see a lack of investor participation?
We'll see the yields go up, and we'll see capital growth diminish a little bit. What's really surprising to me, and I know you've just said, there's lots in the threes, Melbourne and Sydney have always been high twos or early threes. Forever I can remember Melbourne hovering around 3.1, 3.2. It's at 3.9, and it seems to be moving quickly. The last 3 months that we've seen that figure move from 3.7 to 3.8. Now it's 3.9. I keep a careful eye on it because it's my home city. And I'm also watching places like regional Northern Territory and Darwin come off a little bit because their capital values have all increased, and I don't think the yield's been able to keep pace with that. And the rents haven't kept pace, and the yield is what's reflecting that. So, yeah, we have seen all of the yields move up. I mean, Sydney's 3.2. I remember Sydney in the twos.
Yeah. Melbourne.
We're talking about very expensive properties.
Yeah. I think Melbourne will be a really interesting one to watch. I think next month we could see that into the fours and maybe it continuing along. Because if we look at the 12-month increase in rents in Melbourne, it's near enough 5% across houses and units. But in terms of capital growth, it's 0.5% for 12 months. So the rents are moving, but the market isn't. And that just means one thing's happening for yields, right? So who knows, by the end of the calendar year, we could see yields in Melbourne in 5%. When can you remember a time when that was the case?
I can't remember it being 4. I know it's happened in my lifetime, but as an investor, I've been in the market since I was 21, so it was 30 years ago, and I've never seen it in the 4s.
Mm.
It will be interesting. And we've got a state election coming up in November, and what I know about elections is they slow buyer activity down. People get nervous and sit on their hands, including would-be tenants getting out of the rental market. And so I do predict that even in that short space of time between now and November, we'll see that figure jump up a little bit because uncertainty creates a bit of anxiety.
Mm. Let's move to listings, because that's probably one of the early indicators that we can see of maybe a budget response, or at least a war in Iran, an interest rate change response. The month of May, we saw some interesting figures across the cities. Distressed listings, sort of broadly speaking, are down. And, we saw some positive territory across basically every capital city for the month of May.
Yeah, in fact, if we look at new listings, that tells you what's been happening over the last 30 days. The only one that's showing negative is Hobart, and I'm always really careful about using such slight data. I mean, we're talking about numbers of well under 1,000 properties. So Hobart, it can tell some really good stories, but you've always got to be careful of the data, especially when the data points are a low in number. But everything else, we've seen growth. And we've got to remember that we had the school holidays and Easter in April. So, of course, there's always, a bit of muted activity then. But it's showing what I would have expected. Sydney and Melbourne have got some big numbers, and so has Darwin. Darwin's showing almost a 24% surge in new listings in that time. I wonder if people are saying, let's cash out. Value's really high and the landscape's not looking good. Let's put our property on the market. I also note that Brisbane, Melbourne and Sydney are showing, and Canberra for that matter, are showing healthy new listing numbers. Perth is tight, only 7.4% additionally, and I would have thought we'd see some investors bailing out of Perth, but it doesn't seem to be the case. Old listings, we've seen the yearly change is in the red, which means we've got less old listings floating about in every single city. That is a little bit of a surprise. I might have thought that we'd see, that figure starting to blow out in the lower performance markets, but not the case at all.
What do you make of Brisbane? Because that is a bit of a standout for me. Monthly change of 18.5%. That's a fair whack of new listings. And then yearly, it's still minus 1.1% compared to Sydney and Melbourne, which are up sort of 11 and 12%. Is this a bit of a turning of the tide? Could we sort of be
maybe
we're calling the top?
Brisbane's certainly not showing any negative growth, but its pace of growth is definitely slowed. It's not, not in the top 2 anymore, but I think it's still got a lot in store for it. I'm not ready to call it on Brisbane hitting the peak of the market. I mean, advocates that I've been chatting to have all said that they've experienced the same thing with their investors, but, still highly desirable, and they've got the excitement of the Olympics and all of the activity that's going on there.
It's funny though, like with the month of May, we saw Brisbane do 0.9% for the month. That used to be a lot. That used to be like you would be the top of the charts. It's just we've seen this bizarre stuff with Darwin, 1.5%, and Perth 1.5% for a month on an annualized basis. We're talking about Brisbane being double-digit growth if we take the month of May into consideration. It's just hard to kind of stack up to these monster months that we're seeing from Perth and Darwin, right?
Yeah. Look, for buyers, they're staring down the face of a circa $20,000 a month price increase. That's a really hard amount of increase to keep up with. I remember when Melbourne was surging in 2021, and I was saying to buyers, every Saturday that you're not having a crack, your property that you're looking for is moving over 10 grand a week. Some of these cities have been seeing consistent, strong, surging growth like that for a long, long time. I've got a friend in Perth who wants to purchase there, and she asked me if when's the right time, when is it going to slow down, and it doesn't. Data's certainly not suggesting that it is.
What a market. It's been absolutely pumping for, what are we talking, like 4 years now. It's certainly outperformed my expectations by quite some time. That's maybe a good segue, the word expectations, because sentiment is all about expectations, both how we're feeling right now, how we're feeling into the future. I know the ABS shared some data to say that Australians were happier in 2020 than they are today, and they sort of posit that that's probably more about money. I think the financial position post-COVID, I think we were all probably a little bit wealthier back then than we are now. We've got the
we could stay at home, sit on the couch, eat Tim Tams, crack the wine at 3 o'clock. I mean, COVID was pretty awful, but there were some fringe benefits.
Yeah. Well, anyone that was sort of maintained some introversion sensibilities was having a good time. The extroverts were definitely suffering. But how are we feeling right now? What's your read on the Westpac Melbourne sentiment figures?
Yeah, I've copied both charts in from last month and this month. We only just got the June one, so it's handy to have this data at our fingertips. And I remember we were looking at it last month and scratching our heads, but the reality is that, a lot of the data had been recorded before the budget announcement, so we didn't get a real chance to see all of that kind of filter through. And this is telling us what we anticipated, except there's one thing that's really surprised me. So family finances a year ago, and family finances now versus a year ago, and family finances into the next 12 months. We've seen some significant declines there. In 1 month, it's minus 7.5 and minus 8.5, which, that's a lot of people saying, oh, it's not so good. Time to buy a dwelling last month was down 16.1. This month, it's up 12.6. Interesting. Now, when I married that with the house price expectations index, last month it was only minus 1.8. So, less than 2% of people thought that house prices were going to decline a bit. Now it's minus 14.9. So a large number of people saying, okay, now our expectation for house prices is that they'll decline. And marry that up with time to buy a dwelling, we've got a bit of a contrarian snapshot here. Now, whether they're just saying, hey, it's a great time to buy a dwelling, but I'm not going to do it, or they're saying, yep, prices are down, people are nervous, I'm getting in there now, that's the real litmus test. But I found that really intriguing, that it's showing a contrarian snapshot.
Yeah, that stood out to me as well. And I think you're right. It's people sort of saying, oh, I don't think property prices are going to go up in the next little while, which is the reason why I think it's probably a good time to buy, because maybe that also speaks to, look, over the long term, property is still going to perform very well. But in the short term, we've got some issues, we've got some sentiments, we've got some people sitting on their hand. And it's interesting to note people often sort of quote the Buffett style, be greedy when others are fearful. And the sentiment sort of says that to me as well, that people are quite interested in that. But the reality is the percentage of people that actually maybe think that, but then act on that, there's a big divergence between those two, right? How many times have you heard people say, I wish I'd bought at a particular point in time, whether it be COVID or post some sort of shock, but they don't.
All the time. All the time. I've got buyers, literally, they'll probably hear this, but I've got a couple of buyers on my books who have talked about how good it would be to have eased conditions. And some of them have taken advantage of this market. We've had a few acquisitions over the last few weeks that have been very, very sharp. But we've got some that are really nervous and saying, I might just wait and see and sit it out.
Yeah. And I mean, of course, you're talking about real clients and real people, and I've got no vested interest in whether they get off their backside or not, but I can't help but feel like they will regret it. Like any of these people that have said at any particular point in time in the last sort of 5 years, oh, we want to just see what happens, or see what happens with interest rates, or see what happens, with the elections, like when things are moving, they're moving fast. Like think about when
Yes.
the 1 July 5% deposit came through to October. I mean, in the 6 months to March, the properties below that cap have grown about 6.7% compared to 3.4% that are above that cap. Like these are markets where the price is going up, around 50K a month on month. So seeing what happens and sitting around, like how costly an exercise. Like people will probably think, oh gosh, your fee's expensive, but like just not doing something for a month is more expensive than what, say, you're going to charge them to buy a property.
Well, locking in a market like this can be hugely advantageous. And the thing about property, it's not like Coles with a low price guarantee. A lot of people who say, well, I'm just waiting to see what happens, what they're really saying is, I want to see the market return to being healthy so that I know I'll get the upside. But you're not taking advantage of the downside if you wait and see, because when it recovers and you start to see price growth, you've missed the bottom of the market. It's very hard to time it and buy at the bottom of the market. And who's to say that the client who bought 2 weeks ago didn't buy better than the client who bought 3 weeks ago? But right now it's been pretty fierce across most markets, and the buying conditions are very, very different. We've just got to wait for first home buyers to get confidence, for owner occupiers to make a decision to transact, and for investors to either work out, which of them can purchase established, because some can. We were talking about this earlier. If you've got a portfolio already and your cash flow positive, then you've got negative gearing benefit available to you, because it's your benefit will be deducted against your property income as opposed to your employment income. But I think once the dust settles and people understand what's happening, and when I say dust settling, I think once the government have legislated what's about to happen and we've got certainty, whatever it will be, that will give people a chance to take stock of things and say, all right, I'm getting back in now. I know what the rules are.
Let's go to the economy. We haven't got lots of up-to-date data, but of course the GDP data came through. The economy rose 0.8% seasonally adjusted terms. Nominally, GDP rose 1.8%.
Yep.
There's an argument to say that without some of the crazy investment that we've seen in data centres, that would be somewhat of a flat result. So there are parts of the economy, parts of investment that are driving those results. But, I mean, we've been in a per capita recession for quite some time, but this is a pretty low print, and it really calls into question, well, what is the future movement for interest rates? Is there an upside to interest rates in the next little while, or are we going to either sit and hold on, or could we see some cuts in the next little while?
I love it when you ask these good burning questions. If we have a look at the bonds, that then they're certainly not suggesting we're about to have an immediate cut, but we've seen that come off a little bit. I also note that household saving to income ratio rose to 6.9 from 6.1%. Now that's interesting. In the face of real challenges, I was pleased to see that. There certainly is talk, if we go to Rate Tracker and have a look at the predictions for our next rate movement, it's been sitting on 0%.
Yeah.
Yeah, it's just a flat line.
Since the 22nd of May all the way to the 4th of June, a decrease 0%, no change 100%. So all the economists seem to be in agreement that the RBA is not going to do anything right now. It's a wait and see point of view. But the 30-day interbank cash rate futures implied yield curve is kind of saying, okay, well, we might see some increases in the back end of this year before things start heading back in the other direction.
Maybe. Look, I know and respect a few people who think that we're done with increases now and our next movement is down. I'm never so bold as to call that, because we all know that things can change, the drop of a hat with new fresh data. But what we do know is that the pressures we've had on our inflation figures have been things that we'd like to think will pass. And fuel is a huge one, and that's got knock-on effects all the way down the food chain, the construction industry, and across the board. We've also got housing issues, and we know that every state is working hard at solving that. We've got legislative changes that are purporting to help that. I think the RBA must be looking at all of the drivers of our inflation figures, saying, well, how hard can we push this without throwing the nation into recession and really hurting households? And the critical one is business confidence and jobs. What we don't want to do is see unemployment soar.
We saw a bit of an increase in the household savings ratio as well, which I think is another way to say sentiment. When people are a little bit scared for the future, they tend to sort of grab things a little bit close to them and, batten down the hatches, right?
Yeah, we spend less. And if we just, whiz back momentarily to time to buy a major household item, I mean, that's been pretty static. So people aren't buying toys at the moment.
And you mentioned construction. In the March quarter, the Cordell's Construction Cost Index printed a 0.4% growth for the quarter, which is actually the lowest quarterly growth rate since about March 2010. So construction costs, at least in that quarter, are showing, okay, well, things aren't really growing at all. However, that really doesn't factor in the war in Iran, and we've seen PVC piping and products and grow by about 30%. I was talking to a builder yesterday, and what we need to understand about oil is there's different grades of oil. The oil that comes out of Iran is much more suited to diesel. So diesel has been disproportionately impacted compared to, say, petrol, which you can source from other parts of the country. But oil is in all sorts of products. I think I mentioned a couple of episodes ago that it's in things like toothpaste, which is terrifying. It's in nappies for whatever reason. But it's not just diesel, which is the cost to ship things around the globe to construction sites, materials that are moving around the country. But oil is used for things like fixing. So, for example, if you're, any bonding, any glues, any attachments, we've seen a marked increase in that. And a lot of suppliers have added these fuel levies, these war in Iran levies. So there's all sorts of components outside of diesel that have become 7% more expensive as a bit of a rough guide as to what we've seen. And I think HIA is saying that construction costs is probably increased around about $100K for your average home based on some of these shocks. So
isn't that huge?
That's an interesting one.
Yeah, it's interesting. When you hear about levies, I've got a dear friend who runs a distribution, a production and distribution business for cleaning goods, and the cost of the bottles and the freight involved in some of the raw materials, they've had to deal with their suppliers literally putting levies on their freight levies and plastic levies. And it's interesting to hear that, because we go to the shops and we look at the carton of milk or the packet of veggies or whatever, and we get a bit annoyed. But if they broke it down in levies, it would be abundantly clear to us, exactly what all of this war overseas is costing us at the cash register.
Yes, well, diesel comes from oil and plastic bottles come from oil as well, right? And we've seen the oil price, I think we're talking about 96 a barrel. So it's, well under 100 now, but it's not just the actual cost. It's also the insurance costs in and around shipping as well, especially, boats that are trying to run the gauntlet of the Strait of Hormuz. I think we saw last night a US helicopter that was patrolling the strait was attacked by the Iranians, which will result in some retribution from the US to some degree. So I think we're still a long way from solving this problem in what was a war that started out being 4 weeks, was the prediction from the president. I don't know how far we are in now, but I think we're at 8 or 10 plus.
We've just underestimated the importance of long chain carbon chemicals, haven't we?
Yes. Well, that's probably everything that stood out to me for the month that was May. Is there anything else that you observed, Kate, that you think is worth chatting about, or is it more looking
Yeah.
towards the next month?
I noticed the wage price index. That's probably the other one we haven't touched on.
Mhm.
Seasonally adjusted, it rose 0.8% this quarter, which is not setting the world on fire. Across both the private and public sector, 0.8%. So the largest industry contributor to quarterly wages growth was healthcare and social assistance, which is not a surprise when we were only talking in our last market update about the sheer number of public servants and health services workers that we've got in Australia.
Mm. Yeah, the public sector, I think, is driving the majority of the growth. And then, even some of those healthcare providers that might be private, they're NDIS backed, which is probably another way of saying like public soft or public
That's
light,
right.
right?
Yes.
Mm.
Yes. That's my understanding with how they've batched that data. Correct me if I'm wrong.
Yes. Yeah, yeah. I mean, that is
Well,
an interesting one to observe. And I think we mentioned, might have been a couple of episodes ago, that when you compare ourselves to other OECD countries, the percentage of people employed in the public sector is very, very high. I think we're like 27,
vast.
28%, which puts us right up there. So we're leading that charge as also leading the charge in capital gains tax rates compared to some of our neighbours, like New Zealand, who think naught is a good percentage CGT tax.
Be so interesting to see how many startups bail out and jump over the Tasman. But
Mm.
I digress.
Yes. Well, that was May. A lot to come out
It
in the
was
next
indeed.
little while. I think we'll really start to see more and more numbers in the next couple of months, which will be really, really interesting to chart with yourself and, of course, Dave as well, who gives us some really interesting angles in the lending and the economic stuff. So stay tuned is my best advice for any listeners. Of course, we've got some great listener questions and some various episodes coming up in and around policy and what's happening on the ground. But stay tuned with
Yeah,
the Property Trio and we'll keep you up to date.
we will indeed. Dave, we missed you, mate. We look forward to seeing you next week.
Absolutely. Cheers, Kate.
See ya.